2005, and I had aspired to be on our investment team, investment committee, student run, and I didn't have the qualifications to join that group. So it took me a little bit longer, but I appreciate the opportunity to join finally a meeting here and be part of to some degree your discussion. And so I really appreciate time. I thought I in the best interest of everyone's time, I thought I would break sort of my speaking block into three segments here. So number one, PIMCO, who we are, what we do, and then thirdly, why it matters. And we can kind of make this open dialogue. If you guys want to raise your hand or interject, take yourselves off mute and ask some questions, by all means, fire away. But at a very high level, PIMCO is what's known as an asset manager. There are a handful of other asset managers out there. And so if you look at PIMCO, there's some others, you may have heard of some other firms, BlackRock, Eaton Vance, Lord Abbott. So a handful of others. We are based out of California. We manage about $2 trillion in assets. So that's our current AUM. We basically, we are global. We have about over 3,000 employees, and we have about 260 portfolio managers that work with us. And so in terms of what asset managers are responsible for doing, it is basically, managing risk. And our clients run the gamut of institutional investors, so pension funds, 401k plans, endowments for colleges, sovereign wealth funds around the world. And also, as Dan had mentioned, in my role, I work on the distribution side of things. So actually, I take portfolios and in my world, mutual funds that PIMCO has created and manage, and I actually sell those to financial advisors in the area. And so, basically, PIMCO has a lot of different responsibilities, but I thought, primarily, when we say we manage risk, I thought the chart, and hopefully you guys can see it here. When I say manage risk, PIMCO's kind of bread and butter and our brand, if you will, has always been fixed income, so bonds. So I thought this was kind of interesting, as you guys probably focus more on the equity side. I thought what was pretty interesting about this was just showing how we think about risk as it relates to equities and why people may want bonds. Because at the end of the day, what we try and do is we create portfolios that a lot of times will include equities, but we typically manage towards an objective, and bonds are an integral part of that. So this was kind of interesting, just in the sense that, some people, you guys probably know this, but a lot of people really don't. Obviously, bonds are used to diversify away from your riskier assets. So in this case, look, in 2008, you saw the worst drawdown for equities, minus 38. Bonds, worst year for bonds it was about 2.9% back in 94. And so when we think about, the benefits of adding bonds to existing portfolios, it gives us a pretty good indication on how we can manage risk and what those return profiles might look like. So this is another interesting chart, because what it shows you is, if you look at the bottom left, right, you have cash. So in essence, you earn nothing on cash. But if you move up for your returns and further out, assuming you're willing to take on some volatility, stocks, we'll call it just a proxy stocks, call it the S&P on the very far upper right. In between there, you can adjust, right, the risk that you're taking on in a portfolio by incorporating various bonds. Now, bonds come in a lot of different forms, right? So bonds can come in, the form of corporate debt, which I'll speak to just here in a quick minute. But the other big institution that issues debt is the U.S. government and other governments around the world. And so essentially, they issue debt, meaning they loan, they borrow money, borrow our money. They can borrow money from PIMCO. They can borrow money from other institutions, and in return, they offer you an interest rate, or in the fixed income world, it's referred to as a coupon. And so I thought what was interesting to maybe show you guys as a group, if you look at kind of a capital structure of a company, equities obviously are at the very bottom. As you guys probably know, you buy into the equity markets, there's no expectation, or there's an expectation, but there's no guarantee, right, on how much return you could achieve from that position. And so that's considered the highest risk. But actually, in the corporate bond world, as you move up what's known as the capital structure, there are lots of different types of bonds that are at different levels of risk. And so PIMCO essentially goes out to the world, and we use our process, and our portfolio managers choose bonds that are held within various companies, and we go to those investment committees, and we essentially act as a lender for a lot of companies that need to borrow money right now. And what's interesting is, if you look at the environment that we're in, and this gets to kind of my third point on, why it really matters. If you look at the world that we're in, and coming out of this COVID 19 environment, or as we continue along the path of recovery, you have a lot of industries that are picking up the pieces of the fallout of what we saw in the first quarter. So you think of leisure, you think of hospitality, you think of cruise lines, airlines, even areas within banking are going to need to find lenders to help support their capital requirements. I had mentioned the U.S. government as borrowing money. They do that in the form of auctions on treasuries. So what's really interesting about this chart is the current. This is what's known as the treasury yield curve. And the reason this is important to show, at least in my world and in PIMCO's world, is this is how we assess risk. So some of you who might be taking some more classes, in finance, or certainly from a macro standpoint, may have learned, on the very front end of the curve, where it shows that 1 month, that's essentially the Federal Reserve's policy rate. If you move further towards the right along the curve, different plots along the curve can mean different things for various risk assets. But in other words, what it means is you get compensated for a yield the longer you're willing to wait to get paid back. And so if you go all the way out on the curve, which in this case shows a 30-year, the end of the curve shows inflation expectations. And so this is a really important barometer for a place like PIMCO to not only assess what you can get from government guaranteed debt versus what you might get by going directly to a company and lending to them for potentially a higher coupon. So if you're very low in this capital structure, PIMCO might say, well, we'll lend you cash because we have a lot of money that we can do that with, but in return, we might want a 4% coupon. We might want to earn a 3.5% interest on what we decide to loan out. Obviously, the reason this is important, because in today's world, the Federal Reserve has pegged our policy rate at 0. If you're willing to go out for 10 years, essentially what this means is the government is willing to give you 10 basis or 80 basis points for waiting 10 years to get your money back, which is not a very compelling case to make if you want some attractive return on your investment. So at the end of the day, what PIMCO is really trying to do is we're trying to take an institution's risk appetite, and we break that down into thinking about how we can, in a responsible way, inject certain fixed income components to either lower your risk if you're not interested in just taking pure equity exposure, giving you some fixed income exposure to lower your risk, but still allow you to achieve a lot of your goals longer term. And again, for pension funds or endowments, colleges that are just trying to generate some long term returns over X number or a certain time horizon. Again, the risk profile and appetite will vary depending on whether it's you, me, your parents, their 401ks, or some of the accounts that you guys have currently, which are likely to be all equities because we're all pretty young and we may not need necessarily the fixed income to offset some of that risk. So I thought, I'll just pause there. There's a video that I was going to show, and hopefully I can pull this up. Hang on one second. Well, just while I'm pulling this up. Any questions?
Yeah, question for you. So you were saying like the far right end of the yield curve, is that essentially what the inflation expectations are? Or is that what were you trying to say about the inflation expectations in the long dated treasury notes?
Yeah. So when you think about the yield curve, the longer end of the curve is to here. I'll see if I can go back there. I stopped sharing my screen here, but let me see if I can just jump back there real quick. So yes. So the longer end of the curve is typically an indication of inflationary expectations. So without getting too granular, so the Federal Reserve has come out and essentially pegged a goal for inflation to be roughly around 2%. So if you look at these three lines, the yield curves. So again, remember the light gray was 2018, the darker gray was 2019, and then the blue curve is essentially where we are today. On each one of those, you can tell that the longer end of the curve is lower in each scenario, and that what that basically means is the market is currently pricing in right now a lower expected inflation than what our Federal Reserve hopes to achieve. And they're trying to achieve that by lowering front end rates to encourage investment, right? So because front end rates have been lowered, then that kind of pushes the risk appetite further out, and hopefully that encourages economic growth, consumer consumption, and things that will allow that back into the curve to move up a little bit. So that's ultimately what the goal is for the Fed. Now, if you look historically, the last 8 years, the Fed has not been able to really achieve its inflationary target, and so we'll see, if that changes. Obviously, the pandemic didn't really help, but hopefully, does that help kind of answer your question?
Yeah, so like I was reading recently that they were the Fed had made some sort of big decision about their inflation expectations. Like, is that essentially them being more lenient on their 2% goal, or what was the big cataclysmic thing that they decided a couple months ago I was reading about?
Yeah, so they basically decided to have it more of a floating objective, meaning I think in the past the 2% has been really difficult to achieve. And so what they came out and said, I think it was the Jackson Hole speech that was just made, and Fed Chairman Jay Powell basically came out and said that the Fed members had decided that maybe instead of keeping it a concrete number at maybe 2%, maybe the better objective is to have it maybe sit in an average of 2%, because I think sometimes when you peg a number and you give the market and investors an expectation on what you're trying to achieve and you don't achieve it, then typically that means that you fell short of your expectations, and the market typically doesn't respond favorably to that. So yeah, I mean, the Fed basically came out and said, look, we're going to make this somewhat of a floating target, if you will.
Thank you.
Yeah, you bet. And then I'm gonna play this, and then after I'm finished with this, we can kind of open it up for some more questions. Can you guys see this?
We're still looking at your slides.
Got it.
From the
Okay,
treasury
hang on.
yield curve. Maybe if you try to minimize your slides,
All right, hang on here.
might work.
Is that any better?
Perfect, we see it.
All right, so I'm gonna. We'll see if this will work for me.
The life of a portfolio manager is to always be prepared, and that's not just for things that can go well, but also for things that maybe won't go as well. We always want to challenge our conviction. We always want to look ahead and ask ourselves, what could we be missing? Environments are changing. We think markets are going to become more volatile. So having that forward view will make us better decision makers. So this is when we think we'll thrive. I'm Mark Kiesel. I'm CIO, Chief Investment Officer, responsible for overseeing global credit at the firm. PIMCO's bottom-up process is a key component of our overall investment process at the firm. As a portfolio manager, I'm very focused on equity moves, price moves. As analysts, they're very focused on fundamentally, is anything deteriorating or improving? That teamwork is really invaluable, and that's how we ultimately come across our ideas and ultimately what we want to buy and sell in the portfolios. We have a top picks and pans meeting every month. It involves a series of about 5 or 6 meetings around the world with over 100 portfolio managers and analysts. And that essentially is the roadmap for all portfolio managers at PIMCO, what to buy, what to sell across investment grade, high yield, bank loans, emerging markets. And in fact, a lot of the alpha at PIMCO has come from this process. What we pride ourselves on is understanding the details. We want to know everything. In our credit portfolios, we literally have 200, 300, 400 positions. So the level and depth of knowledge that's required is significant. I think some of the most exciting moments for myself at the company have been with the analysts, visiting the companies, and really coming up with insights that we saw ahead of others. For example, we were early and identified the housing crisis 2 years before it happened. We thought the inventory problem would worsen. We thought housing could fall 30% and ultimately ended up happening. Also in the recession, when no one wanted to lend to the banking sector, our analysts were there helping to essentially recapitalize the banking industry. And because we were there, we were able to negotiate terms and get deals into our clients' portfolios. We're not in a position where we want to necessarily close those positions. One of the things that PIMCO benefits from is having a long-term orientation. As we look out going forward, one area of opportunity we do see is in the global consumer. Incomes are rising. And in fact, as incomes rise, people tend to spend more. For example, the US consumer spending accounts for 68% of the economy. In China, it's only 53%. China's consumer will come online, they'll expand their wealth, they'll take more vacations, and that more of China's growth will come from the consumer. And that China has some catching up to do. If you look at China consumption, it's 50. But having that forward view gives us advantage because we ultimately want to buy companies not based on past results, but where they're going. The beauty of this is that all these companies vary. They're all in different industries and different countries. And so the ability of active managers to add value is significant. And that's something we do at PIMCO. We have very high standards. We want to deliver not only strong, consistent performance, but also superior service to our clients. One of the things we always pride ourselves on is that if we've had any success in the past, ignore it, wake up every day and earn it. And that's something that we're very proud of here at the firm.
So hopefully, hopefully that was kind of helpful. Were you guys able to see that?
Yeah, that was great.
Okay. All right. Good deal. Well, listen, I know, it looks like I have about probably, 10 more minutes. I can kind of go into, some of the things that are happening globally here and why, some of the comments I just made, kind of makes a difference, more of the why it matters part. I don't know, Dan, if you have any questions that you have teed up or if anyone else wants to chime in, but happy to do what's in the best interest of the group here.
Yeah, that'd be great. If anyone has questions, please ask now. I know Shore is probably the smartest guy in this call by a long shot, but he's very nice. He won't bite, so ask away.
I was just curious a little bit. It kind of talked about how you guys evaluate to where you purchase an asset. What is would you say the full process? So from the first time, a possible buying of an asset comes across, what's that full process look like? It can be pretty brief and just kind of what is that process?
So a lot of times we are in a lot of ways, I would say in a lot of cases, rather, we tend to be the largest clients of a lot of of a lot of the companies that we work with. In other words, we may own bonds of companies, whereas if you go back to the first quarter, for example, let's just use that as an example. If a company gets in trouble, in other words, they are at risk of default or they run into solvency issues. And from the very outset, we've recognized that as a sector that's worth paying closer attention to because of the potential fallout from, say, like COVID-19. What you've seen is a lot of stores, kind of the brick and mortar stores. I can't share any names, but if you look at some of the companies that have filed for Chapter 11, PIMCO, in a lot of cases, is actually the bondholder of those, the majority bondholder in a lot of those companies. And so what we will do then is we will sit down with the company and we will say, hey, because we're a majority bondholder, and bondholders typically get their money back, right? Because that's the whole idea behind the debt in the capital structure versus the equity. Then we will have a seat at the table of what's called their steering committee. And as a member of their steering committee, we can actually help restructure the debt component of their bankruptcy filing. And we can then what's known as collateralizing some of that debt, in the best interest of shareholders. That example can be applied to a lot of different sectors, but in essence, we from a very top level will look around the world. It might be emerging markets. It might be the example I just gave you was more on the corporate bond side, and that the gentleman you just saw, Mark Kiesel, he is more focused on the corporate side of the equation. But again, we may look at Australian. So the Treasury curve that I just showed you, that's the U.S. Treasury curve. Every country, right, issues debt. So you could go to Australia and you can look at their Treasury curve. You can look at Japan, their Treasury curve. Their front-end rates are negative right now. So you can go globally and look at where are the best opportunities to earn incremental value with the least amount of risk. And that's essentially what we're looking for. So it's not always a deal structure with a company. It could also be going out and buying, longer dated kind of AAA Australian, debt. It could be looking in Brazil. So it comes in a lot of different ways, and so it's kind of hard to come up with an example like a one size fits all. But hopefully that gives you a little bit of color.
Yeah, it does. Thank you.
I guess one kind of real example that's taking place today, and I kind of alluded to it a little bit earlier, but with U.S. rates being so low, even if the Federal Reserve doesn't necessarily achieve its inflationary target, if you look at the level of inflation today versus what you're earning on some of those short end bonds, you're essentially underwater, right? So if inflation and the cost of goods and services is going up, which is essentially inflation, and you're not at least earning that amount on your short-term bonds, then that's incredibly problematic for folks like my parents, and people that need to earn some sort of interest on their safer money. And so, and Dan and I were talking about this a little bit a while ago, but what that has caused people to do in a year like 2020 is now you have folks that are a little bit older that don't necessarily have the risk appetite of owning just equities, but they've had to over allocate towards risk assets because they have to earn some sort of return or yield if they're buying dividend stocks. But that has offset, basically it's meant that people that should not be over allocated towards equities are buying equities because there's really nowhere else to be positioned right now in the context of an overall portfolio. So when we look at the years ahead after the fallout of COVID, managers like PIMCO are working overtime to try and find ways where older the demographics of our population aren't required to necessarily go out and buy all stocks. But and that's been a big reason why you've seen significant moves up in the equity market. Obviously, and you guys probably talk about this too, but if you look at the FANGs, and you look at some of these other names on a market cap weighted basis, those are the companies that are really tilting the scale. But because investors don't have many other places to go, and if they're not comfortable analyzing their own equities, then they throw money into the S&P, the Dow Jones, index funds, and that has contributed to the rally that we've seen. And so there's somewhat of a concern, I guess, if that maybe that's a safe way to put it, a concern that that folks are under allocated to the safer parts of the market and maybe over allocated to those riskier assets. So anyway, that just kind of puts things in more of a real life. Hopefully that's not too difficult to understand, and I've said that in the right way, but hopefully some of that's helpful. But again, I know sometimes I can get caught up into the whole market speak and the PIMCO speak, but I really hope that some of this was helpful. And I think what I had hoped to achieve was, as you guys probably spend most of your time on the equity side of things, just kind of give you a glimpse, into the other part of, kind of an asset allocation process, and just in terms of fixed income, how that, how granular that can get, how complex it can be, but how important it could be in terms of offsetting risk for the longer term.
Yeah, thank you so much, Shore. I greatly appreciate it, and we won't take up too much more of your time. We know you have a pretty busy schedule, but this has been very enlightening for me and all the members, and I just appreciate you taking the time out of your busy schedule to talk to us. So thank you
Absolutely.
so much.
You guys have a nice evening. Thank you again for allowing me some time to speak to you.
Yep, thank you, Shore. Have a good one. And investment club members, please stay after. We still have 30 more minutes left. So, all right. So hopefully you guys like that. I'm gonna kind of give you guys an option here. I was kind of debating on what we can do for this meeting since we only have 30 minutes left. Do you guys want to kind of have a discussion about the upcoming election and the effects it may have on the financial markets? Or do you guys want to look at our portfolio and make changes to the portfolio or take a vote? What are you guys thinking? Just shout out an answer.
Can we talk about the election and maybe make a plan for stuff we would want to sell depending on how the election turns out?
Yeah, no, that'd be great. Awesome. So I'll kind of kick off the discussion, I guess, about the upcoming election. I'm sure, as most of you know, if you're at Drake, you've been bombarded with political advertisements, students talking to you. Not as bad as caucus season, but still a little overwhelming. So I'm just kind of curious what you guys think about the outcomes of the election and how it may affect the markets without being too mean to each other. We all have our own political views, so let's stay nice and think just more factual based. Shorty, were you trying to say something, or are you on mute? No, he's like, no. I can share one thing with you too. Let me see here. I'm going to share my screen. We can look up S&P, or we'll actually just look up. Yeah, we'll just do S&P performance, Republican versus Democrat. Oh my gosh, I can't spell. Okay, I typed that way too fast. And I'm gonna get this bar out of my way. And we can look at images because I've looked at these charts before. Let me look for a good one. These are all like GDP growth. This will be a decent one, I guess. So if you kind of look at this chart, you can kind of see Democrat is obviously blue, Republican is red. You can kind of go back to 1930 and see how the S&P has performed. And there's not like really a strong correlation between Republican or Democrat. As you can see, usually there's a strong uptrend. So like my kind of whole theory with it, and like I could definitely be wrong, is you really don't want to invest based on elections or based on presidential elections, because historically it hasn't really done anything too crazy. But this election, some might even make the argument, and I'm trying to play devil's advocate here too to get both sides, and I could or could not agree with this. I'm trying to be a little objective here. That Joe Biden is, he's kind of came out and said he's going to raise tax rates, and he's going to raise tax rates on the upper class as well. And obviously the financial markets don't like that, and that'll allow many of the big corporations that are in the S&P 500 to perform quite poorly. And kind of during the Obama administration, after, can you see my mouse, guys? Yeah, after the Obama administration, after the recession, the Obama administration came on. They really didn't do anything too crazy with taxes, and they kind of did a lot of quantitative easing within the Federal Reserve. So there was good performance there. So there's not really a fair answer because every election is the same. So who knows what the effect of increased corporate taxes could be, because they're not going to get lower than what they are right now. I can almost guarantee that. So if Trump gets elected, I highly doubt taxes will get lowered. If Biden gets elected, it's a very big probability that taxes will get raised. So I'm just curious, what are your guys' thoughts on that?
I guess one thing is like, you hear kind of like, obviously a candidate can say whatever they want to say, and like you can believe what you want to believe about what they're going to do. But then once they get into office, they can do entirely different things. But I guess just to look at both sides, I mean, Joe Biden obviously says like, a reformed healthcare plan that's like reinstating this and that. And so that could mean, possibly healthcare stocks would improve. And then Joe Biden looking at new renewable energy would mean, maybe Tesla, and I can't think, what is it? No, I can't think of the one that starts with an N. Those electric car companies, electric car companies, that'd be like, another thing. And so there's all these different areas that you could see a spike in if Joe Biden was elected, or if you see Trump is elected, what areas are they going to spike in? So there's just, maybe if Joe Biden gets elected, good things happen, maybe not. Maybe if Donald Trump gets elected, good things happen, maybe not. So you can look at kind of what their policy is and what changes they are trying to implement to see if those would positively or negatively affect a specific market.
Yeah, exactly. Great input, Jack. And like Jack said, what I was showing is just a very broad market overview. And Jack said, hey, specialize in maybe special companies that can do better. And I personally bought some United Healthcare a week or two ago to kind of hedge on the possibility that if Joe Biden gets elected, they'll do pretty well. If Trump gets elected, they probably won't do anything crazy. So it's always good to prepare your portfolio. I mean, obviously, if you buy ExxonMobil or other companies kind of in that sector, maybe they probably won't do as well under Biden, but they'll do good under Trump. So it's really important to see kind of what your allocations are if you have individual stocks that you're investing in. But if you have a very broad market overview and you're very diversified in the S&P 500, maybe you shouldn't worry as much and not get emotional, because I'm sure half the people in here have a strong, passionate, I don't know, whatever for politics. I'm like, oh, I hate Trump. Oh, I hate Biden. If this happens, the world's going to burn. Generally, that won't happen, no matter how big of a deal it might seem like right now. I mean, if Biden gets elected, the sun will still rise the next day. Same with Trump. It always has, it always will. So it's just good not to get too emotional when investing. And usually the emotional investors don't last too long. So strip emotion out of it and don't get frustrated, but try to figure out the way you can work with the changing times instead of getting upset. I mean, you can't really control who gets elected, so don't throw a big hissy fit. Just change the way you're doing things to adapt to the changing times. That's all I can say. Anything else people want to kind of plug in there? Nothing? You guys want to talk about stocks that might do well under different candidates? Maybe Trump and Biden, we can create a list. Anything? Come on, guys. Killing me.
I think that'd be a great idea, Dan.
What, do you have any ideas, Cal, of what stocks?
Or we could evaluate our portfolio and determine, what we think would happen to each stock so it's more personal to us.
We can do that. Let me find the Excel sheet here. Somewhere in here. All right. So here's our portfolio. I didn't update the numbers today, so this value is 2 weeks old. But here's our portfolio, all of our allocations. So you just want to go down the line and kind of talk about the effects it might have of different candidates. If it's safe, if it's risky, if it won't be affected. All right, so we'll start with Apple. What do you guys think? Someone? I don't want you guys just to hear my opinions. Cal?
Well, we lost money on Apple because the current share price is 116. So, but I think
this is a total cost basis, I think. So like,
yeah. What about that current price per share? Oh,
so this is like the total, like 12 shares times our cost price is like
yeah.
the total cost, and then our total value is right here. So this is what we initially paid for the 12 shares, and then this is what the 12 shares are worth. Yeah.
Right.
But it did go down a little bit, yeah.
Yeah. That's all I got.
So we're trying to judge based on, you said the presidential election, right?
Yeah, correct.
Yeah, that's going to be kind of hard because just as someone who's just said earlier, like the policies that are actually done versus the ones that are said are usually very different.
That's true. That's true. Yeah, and it really depends on the candidate too. I know, try not to be biased here, but like a lot of the things Trump kind of, at least from an economic standpoint, I can't say social, he kind of has done a lot of what he did say he was going to do on the 2016 campaign trail, kind of like the tax cuts and deregulation, and he kind of held his word on those. So he did do that. I don't know about Joe Biden's track record of what he claims to do versus he does do, but I don't know. For me, Apple, we can kind of go down the line and be like, assuming the candidates go through with what they say and they can push it past legislation for the different whatever political agencies they have to go through.
I know I'm not sure how much this has already affected Apple's stock, but I know the DOJ filed suit against Google with the about how Google uses has a under the table, not under the table, like agreement with Apple to use like Google as like the default search engine for like Apple products. So I'm not sure how much that will affect Apple depending on the way that goes in the courts, but I know that was all over the place last week, I think.
Oh, interesting. I didn't hear about that one. I heard about a lawsuit
I
with,
didn't hear about that. That's why I think that's why Apple stocks fell so hard though recently. That's actually interesting. Thank you for that.
yeah.
Because I think Google's like 15% of their revenue comes from this agreement or something like something big number comes from just the fact of their licensing to these big things, and DOJ obviously doesn't like that. So
Wow.
I'm not making an opinion on the suit, but I'm just saying right now there's a suit.
Do you who'd you say is filing the lawsuit against them?
Department of Justice.
Ah, interesting.
I don't know what the merit. I don't know if I haven't read too much into like the merits of it. I know there was a suit filed to try to quash this agreement.
Okay. Yeah. No, I didn't really hear about that too much. I did hear about a lawsuit against Google because they were tracking people using incognito mode without their consent. So that was a whole nother thing that I heard about. But yeah, that obviously isn't good for Apple. And you said 15% of the revenue comes from that, Apple?
I have to confirm that. Don't quote me on that. I'm gonna double check on that, but it's a big number.
Mm-hmm.
Don't
Yeah.
quote me on that.
And a lot of these big tech companies, it's really hard to say with the kind of like Nvidia will do well, like kind of like more of the upcoming stocks will do well. But yeah, I'm trying to look through here too. I think actually I haven't updated this since we sold Disney, so I need to update that too. Yeah, I'll update this portfolio once we're done. Yeah, a lot of these big companies like Apple that are making a lot of profit, Microsoft, Starbucks, Walmart. I don't know about Disney, they're not making a lot of money, but Waste Management, obviously they'll kind of be hurt, and Verizon, they'll be hurt pretty hard by the corporate tax rises if Joe Biden does implement those. But at the same time, it might be offset by maybe Joe Biden maybe having a more of a forward outlook with technology and growth and sustainability. I know Apple's big with sustainability. Obviously, Nvidia is, Microsoft. So like maybe those stocks will do very well under Biden, maybe they'll do bad. It's hard to say. But under Trump, I would probably just say it'll maybe remain the same. He'll probably he can't lower taxes more than he has, and he just probably could cut regulation. So that's kind of my 2 cents, is kind of looking at what the prominent looks like we got meeting there. Okay, yeah. But just kind of looking at what their policy is, what they will help and what they'll hurt, and taking into effect taxes, because taxes take out a big chunk of every corporate's earnings. So I mean, 21% is still a big chunk, even though it's one of the lowest we've ever seen. So just always kind of factor that in and know it might be a possibility, and especially if the parties that win the presidency and go into the Oval Office, they might take over the House and Senate. So you kind of have to factor that into, is will they work together? Will they work against each other? And that's another factor. I'm not too big into politics. I used to be, but kind of taking a break.
I have a quick thing. So I'm pretty sure that obviously everybody knows COVID-19 is a thing,
Mm-hmm.
and I'm pretty sure that no matter who gets elected, I think one of the early on policies probably for something that is against COVID-19. Do you guys think that any pharmaceutical companies will see a surge, or do you think it's just going to be on and off as it has been? I'm actually kind of curious on that.
Yeah, great question. What do you guys think?
I can't think of it now, but like, shoot, it was back. I can't think of when it was, but like I personally didn't invest in it because it was like after it happened, but like I did some backtracking and I saw like one stock. I can't think of the name now, but I'll do some looking around, but it spiked like 32% in I'd say like a 2-week period. And my uncle actually bought it like low, and then the 32% spike, and then was able to sell it off. So he made a pretty decent amount of money. So I'm gonna look at that and see what company it was. But
There's a few. I
Yeah,
know
yeah,
that for a
yeah.
fact because I've done them. But the problem is that like even with those, they're really volatile.
Yeah.
Like they're really volatile because they're fixed. Like almost all of them. There's like probably a few really, really, really wealthy people who control how it works out. And so the problem is though, I don't know enough about the pharmaceutical companies and who owns them to know how they think. So I can't predict it. And that's why I'm kind of asking you guys for a little help on that. Because recently I have took a major hit because of one of them.
Oh no.
It was man, what was it? Let me Google it. It started with a W. It doesn't matter, but it is what it is.
Yeah,
You win some, you lose some.
exactly. Yeah, I don't think I've really invested in pharmaceuticals before, so I can't really say an expert on them.
Yeah.
It's just
No.
I kind of invest mostly what I know. So I wish
No,
I could
that's correct.
wish I could help you on that. I mean, sometimes
no.
I'll throw some play money around in like Nicola or something just for fun, just to keep me entertained. But other than that, no, I just try to invest in what I know.
What you do is completely fine. Because I mean, the thing of it is the way stocks work, it's like it's your own like, and it's how you think, literally.
Exactly.
And if you're able to do like if you ever understand how you think and then how others think, you will be successful. It's just inevitable. Problem is that you have to figure out how you think and how it relates to the world around you.
Exactly. Any other comments about that or anything in general? Just want to have an open discussion. It's kind of more fun when it's just laid back.
I guess I'll just keep on shooting.
Yeah,
then.
go for it.
Oh, what else when it relates to stock wise? Okay, do you guys use any news sources? Last time we talked was the extra meeting, and you gave me the what was it, the EDGAR filings, which were actually really helpful, and something that I didn't really look over, the Securities and Exchange Commission. If you guys don't know what that is, and they tell you like all of the things that have occurred. And it's kind of interesting because if you try to search for larger companies like Apple's filings, they have them all coded. So you have to you have to know the individual types of codes in order to know what type of exchange occurred. They don't publicly release it. It's just kind of funny.
Yeah, no, that's a great site too. And kind of what James was referring to was SEC Edgar. You can kind of look them up, and every quarter, every public company has to report basically what they say is their earnings, but it's way more than that. They probably have hundreds of pages almost, it feels like, of just like more information than any human can ever take in, but humans still take it in. And it talks about everything from their financial statements, what's going on with the company, changes, governance, anything that relates to the company is probably in there that happened within that quarter.
Insider trades as well.
Yeah,
exactly. Those also will pop up.
Everything.
Yeah. Everything.
Yep. Everything under the sun will just be in there. So if you really want to like expand your financial IQ, just go to SEC Edgar, look up a company like Apple and look at their quarterly reports and just read through it. And the majority of that stuff you won't know. The majority of the stuff I don't know. And just the stuff you don't know, look up, become more well-rounded with it. And that's just like the fastest way I'd say you could really learn about investing and knowing how companies operate in many different forms. It's just hard to say exactly what the report is, but it's just everything about the company that you would possibly need to know.
Yeah.
So
I'd also say follow up on that. Look at the past. Like the past happened, it's true. that is literally fact. Like why did that occur? And then see if it's occurred multiple times. And if it has, could it happen again? And how does it relate to what's happening right now? Just little things like that. And Edgar, it's hard to see it, but if you can slowly kind of draw out some of the junk information, you can start to see things that kind of match up to what's currently happening.
Exactly.
but it's quite hard and dull. I'm not gonna lie.
Yeah, no, that's a good point. And usually, like when you want to look at those trend things, I usually just go on Yahoo Finance and kind
Yeah,
of look at
that's
those
a
trends.
super good one.
Just more of like an outward approach, and you kind of get to look at it from like a more of a holistic standpoint instead of just having tunnel vision into the single quarter and looking at
all the numbers on
Yeah.
Yahoo Finance. It's super
Mhm.
nice.
So yeah, if you really just want to learn about an individual company and just get to know it, look at their quarterly report. If you want to look at their past and how they're performed and their company as a whole, Yahoo Finance is probably the place to go. So there's an infinite amount of sources of information on these companies. And I like read Barron's, Wall Street Journal, Yahoo News, Yahoo Finance, SEC Edgar, you name it. There's an infinite amount of information, it feels like. Even in Lower Alabama, if you guys are interested, they have those Bloomberg terminals. I'm sure some of you have used them. I haven't used them for a class yet, but I've used them for personal reasons. And those also are jam-packed with information. If you're not staying home, of course.
Yeah, I wish.
Yeah, but those terminals I think are $17,000 per monitor or something around there, which is insanely expensive. Let me see. I want to make sure I got that number right.
So we can just walk in and use them if they're not in use, is what you're saying?
Yep. So if you want to nerd out in front of them for 10 hours, be my guest. And I've been there. Oh, $24,000 a year per like terminal. So I think we have like 5 in the study room in the basement, and then we have more in another classroom, like maybe like another 5. So this is stuff you probably won't have access to after you graduate. So maybe capitalize on it now, and just once you graduate, you can flex saying, yeah, I used a Bloomberg terminal. You're like, what? No way.
You should
So-
get Kevin Croft to come talk to us, Danny. He's
Kevin Croft.
he's a professor here, and he was the one who got those Bloomberg terminals into the school.
Really?
I didn't know that.
Dang.
Yeah,
And
I know he's really
donated, right?
smart.
He worked on Wall Street. He covered. I can't remember how big his portfolio was, but it was in the 100 millions.
No kidding.
He's my finance 101 professor.
Wow.
Yeah, you should definitely email him or something.
I think I've emailed him once before, but not
He's a
about
great
any investment
guy.
fund.
He's
He's a
really
great
smart.
He's so good. He's so
Really
good at
smart.
teaching too. He does a really good job.
Dang, that's awesome.
Yeah.
Yeah, no,
Yeah, he also has like a lot of good connections. Like he's like reached out to a couple of people to try and help me. So I don't know whether he would be able to get like people to talk, like even at this group as well.
Probably
I know
would,
there's like a lot of
actually.
people in this.
Yeah, he would probably come here, and then we would talk. If we could get a discussion going with him, then he would like us, and then we can probably get connections off of it. That's usually how it works.
exactly. Guest speakers love discussion. They love interacting. So that'd be great. Yeah, I'll probably reach out to him. It might be sometime probably next semester later. I'm probably not gonna have any more guest speakers for this semester since it's kind of coming to a wrap. And I don't want to like really push it on anybody. I like to give them a bunch of time. I know we have some people from the CFA Institute, Chartered Financial Analyst Institute, coming in like February. I have scheduled, and I'll probably get some more then too. But I try to get a lot of guest speakers in for you guys so you can kind of get a real experience of what it's like. I've never been on Wall Street. I've never been in these big firms, so I can't really do as good of a job as those guys can with telling you what it's like. So I try my best to get those people in there. And yeah, Kevin Croft obviously sounds like a pretty incredible person that I'll have to get in here sometime. So I'll probably be in touch with him, but probably later in the year. We'll save the best for last. All right. Well, I'm probably going to end it here a little early. Thank you guys for coming. Appreciate it. If you have any questions or just want to talk about investing, email me. I'm a nerd for it. I'm not afraid to admit it. So I love it. So yeah, thank you guys. Have a great night, and I'll see you. When is the next meeting? On the 10th, November 10th. All right, have a good one, guys.
Thanks, Dan.
Excellent. Thank you.
Peace.
So do you not just like have a Bloomberg terminal in your basement? Is that like weird?